The outlook for the global economy remains broadly constructive. The US economy has continued to set the pace, and consumer spending has kept domestic economic activity above trend. Constructive economic conditions will likely foster a cautiously positive environment for risk-taking and investment performance over the next 12 months as a whole. But political risk remains the key challenge to this outlook. I'm Michael Sager. Welcome to the 2024 fall edition of Perspectives. Inflation in the US and elsewhere has continued to moderate and looks to be a weaker constraint on central bank policy decisions than it was at the beginning of 2024. With major central banks now cutting interest rates, fiscal policy becoming more supportive of economic activity, and investment spending likely to become a tailwind, we continue to expect a gradual recovery in global GDP growth. For the next 12 months, the key drivers of longer-term investment performance will likely remain supportive of risk-taking. Given that, we think that equities and bonds can both make a positive contribution to investment performance and see little reason currently to favor one asset class over the other relative to strategic allocation weights within investor portfolios. The strong equity returns realized for this year as a whole have been driven by a combination of earnings growth and higher valuation multiples. Given our constructive outlook for the global economy, we expect that earnings can continue to grow at a moderate pace. This will likely be supportive of further, albeit more modest, positive equity performance in coming months. After 2 years of underperformance, Canada has been one of the best performing markets in recent months. The Bank of Canada started to ease its policy stance in advance of the Fed and has indicated it is likely to continue cutting rates as inflation has moderated and the labour market has weakened. We expect the Canadian economy to respond positively to this stimulus and for its growth recovery to exceed consensus expectations. US Treasury 10-year bond yields are trading close to our estimate of long-term fair value of 4.1%. Over the next 12 months, we see 10-year yields trading in a range around this level, with a gradual global growth recovery and moderate inflation suggesting little reason for a significant sustained move in either direction. The slope of the US and Canadian yield curves recently turned positive for the first time since 2022. We expect the yield curve will continue to gradually steepen in coming quarters. Bonds will continue to be an important source of ballast in multi-asset portfolios and to provide continued useful diversification relative to equities. Canadian productivity performance remains poor, in part reflecting years of underinvestment in the Canadian economy. As a result, the loonie is likely to continue to oscillate in a range of 70 to 76 cents in the coming year, which is well below our estimate of its intrinsic value. Things can change on a longer horizon. We still consider the US dollar to be overvalued and likely to weaken against a broad set of currencies, including the Canadian dollar, over the next several years. But that's not an investable insight for the time being. In a world of heightened volatility and US cyclical economic outperformance, the US dollar likely stays strong. Political risk remains the key challenge to our cautiously constructive market outlook. In particular, rising uncertainty associated with possible election-driven policy changes often encourages investors to try and time market participation. Frequently, this has proven to be the wrong decision. Fundamental factors such as economic growth and inflation are the key drivers of longer-term investment performance. Staying invested in a well-diversified portfolio through short-term volatility, whatever the source, has typically paid off. For the full Fall Perspectives report, visit the CIBC Asset Management Insights Hub.